And one of the results of that, there's several results to that, but one of the extraordinary results to that is the amount of leverage, the amount of debt in American institutions and in American households skyrockets over a 20 or 30-year period. Absolutely skyrockets. If you measure it against Martin Wolf recently in the Financial Times had a really nice little article where he looked at the amount of debt in households over 20 years and how that has increased as a percentage of gross domestic product, or same thing with financial institutions, right? All of a sudden you've got this extraordinary amount of leverage and it's risky, right? And you at the same time have this, you have this deregulation, right, that is going on, and you've got certain kinds of instruments that are supposed to manage risk, that are supposed to hedge risk, and they're out there in the sort of global stratosphere, and nobody really knows how to account for them to some extent, right? You've got now this market, for example, of $60 trillion worth of something called credit default swaps. And nobody exactly quite knows where they are or what they are. There's no clearinghouse for it. The New York Times did a wonderful little article about on Sunday about the attempt by some people in the government who were just like us, right? Just regular folks trying to say we better get a handle on this, and how and this, by the way, this wasn't just the Bush administration. This was the Clinton administration too, right? There's enough blame here to go around. As markets were good, as things were moving forward, it was just let's just let it roll. It'll regulate itself. There's a kind of an ideology here about self-regulation, or about the capacity of markets to regulate themselves. And, to some extent that's true, but for certain things and for many other things, it certainly needs a lot of help and a lot of supervision. And the issue was not just what was regulated or not, or what was not regulated, but the issue was what was the capacity to actually supervise it and have enough information to understand it. So you get all of this, and at the same time, then the housing market falls down, and the value of those assets goes way down, and now you've got the big bust. And the big bust is not just people who are losing their homes, right? Because all of a sudden the rates reset, the value of their home is much less than the mortgage, but now you've got something else going on. Financial institutions that all of a sudden, when they mark to market, or when they look at the quality of those assets, or they try to figure out how to get rid of those assets, those mortgage-backed securities, other kind of mortgage-related paper, other asset-backed securities, that value goes way down, and all of a sudden they're not adequately capitalized. They don't have enough equity. They don't have enough net worth. So we were talking about Alex's Lemonade Stand. It was a wonderful little charity that I've been part of. We've raised $25 million for pediatric cancer, largely by selling lemonade stands. I would not have predicted, largely by having lemonade stands of people all over the country. Hope you have one in your neighborhood. I would not have predicted that we would outlive Lehman Brothers or Bear Stearns. I certainly would not have predicted. I certainly would not have predicted that we had more net worth than Fannie Mae and Freddie Mac combined. Now, and I sort of say this because this happened like overnight. This was unprecedented. It felt like it happened overnight, right? And so all of a sudden the question was, what was the capacity to respond to this? What was the nature of the, as they sort of say, contagion? How much of this stuff is out there? And what would its ripple effect be for the economy at large? And so we know, sort of some of that as it played out. So, all of a sudden you get the Fed and the Treasury Department saying we maybe have to intervene in ways that we didn't think that you could intervene, that they would intervene before, right? I mean, this is extraordinary that overnight, for something like AIG, that the Federal Reserve, or for Bear in the relationship with JP Morgan, would intervene in the way that it intervened. But to intervene, if you're the Treasury Department or if you're the Federal Reserve, the assumption or the theory, and I believe that people acted on this, would not be that you would intervene just because you want to save one institution versus another. That's the theory. The theory is not that you want to save an institution. The theory is that you think there is systemic risk from one institution going versus another, right? Now, you could ask, again, citizens can ask good questions. Prove it to me. How do you know? Why was it systemic risk for Bear, not for Lehman? What do we not know about the, you can come up with all sorts of questions about this. But of course, you didn't have much time. And the question was, where do we intervene because if we don't intervene, and there is indeed this extraordinary amount of systemic risk, right, the system as a whole, then you'll have a problem. So you get this in part, and if I were to have a critique of this, as I'm sure many people, you included, would, you get a kind of a reactive mode, right? As events happen, Treasury or Fed begins to react event by event. The question was there, at what point was there a systemic understanding of the over-leverage of the system, of what markets by themselves could do or could not do, and of what role the public sector would have to play. Now remember, this was an administration that is not, this is an administration that did not start out to become the largest public intervention in the history of American capitalism, right? This was not on their mind. It was not, well, you know, we'll do this versus we'll do that, right? I mean, this is not, they weren't thinking this. This wasn't going to be like Comrade Bush, right? This was not the way they were thinking. So to do this, you've got to think that a lot is happening and it is going to damage the system in some irretrievable way that would become a significant problem. So there were two kinds of crises that at the same time everybody, is this understandable, by the way? Does this make sense? So there were two kinds of crises that they were dealing with, and to some extent, many people felt like there was some confusion about, at different times, what did they really mean? Or were they right about which crisis versus the other? To some extent, for some institutions, and we hear this now, there was a crisis of what's called liquidity. There's not the money, people don't want to lend. There's not the money to lend, or I don't trust what's on your balance sheet, so Lord knows I'm not going to lend to you, or I'm not going to deposit there because I don't know whether the bank is going to belly up. So you've got a question of liquidity. And then also, at least that last comment, was a question of insolvency. So was it about liquidity or was it about insolvency, right? And for some institutions, it's maybe liquidity. For some other institutions, it's maybe insolvency. And so the question becomes, where in the financial institution, where in this mess do you intervene? So we had a variety of different things. They rolled out one by the other. They still roll out. They still are being explained. It is still, we are a long way from a 3-page memo that asked for $700 billion with no oversight, but they're still sort of rolling out, right? Life is iterative, you all know, as artists and creative people, so it's still rolling out. So just think of what we've seen in the last 6 months. I mean, it's really, really extraordinary. We've seen a stimulus package, right? That seems like a million years ago, right? The stimulus package, remember that? And that was like a big deal, a big government intervention in the economy. There was a stimulus package. Then there was the housing package, the $4 billion of the housing package, which was how do we keep people in their homes, although it had different issues related to that. There were an extraordinary number of guarantee programs to keep people, all of a sudden, banks, governments not only here, but to some extent more effectively in some other countries began to say, we're not going to just guarantee your deposits up to $100,000, we'll guarantee them, as the US set up to $250,000, and then some countries began to say, we'll just guarantee them, right? Remember? I mean, 2 weeks ago, Ireland just said they're guaranteed, right? And Germany said, that's ridiculous. And then by the afternoon, Germany said, we're guaranteeing them too. Because all the money's going to go to Ireland, right? And so they said, well, we're guaranteeing them too. And then you got, well, we're going to guarantee, interbank lending, because a lot of how an economy moves is one bank lends to another. You have the LIBOR in the UK, and you have other kinds of interbank systems that are mediated through the Fed. And the question was become, will we guarantee, all of that? And then you had the question of, what busting the buck is. Everybody's trying to go to a safe place to put their money, and the question was, are money markets safe? And that seems, Lord knows you don't get anything in return, right? So that seems like it's safe. But the second it busts the buck, goes below $1, right? And a dollar, value for a dollar, then people say, oh my God, money markets aren't safe, right? And at that point, the government turned around and said, we're going to find $55 billion. I don't know where this math came. $55 billion, and it is going to guarantee what, in essence, was up to $4 trillion of money market funds, at least for a year, maybe later. We'll see, as my grandmother would say, right? We'll see.